Klaus Blaabjerg, your lead portfolio manager for high-yield value bonds. Last year you delivered a return of more than 80% and were far ahead of the benchmark. How has 2010 been so far?
2010 has been very good so far, both absolute and relative. We have delivered a return of 9% after the first quarter, which is around 3% more than the benchmark. So I would say it's still very good compared to the benchmark.
What has driven the returns?
The driver behind our return and our outperformance is basically, first of all, lower default activity in our fund. We have had 0% default this year, whereas for the market you have had 7% defaulting. Also, last year you saw less than 1% defaulting in our portfolio, whereas you had around 11% for the market. So it's really lower default activity, but also what you've seen in basically the last 6 months or so, I would say, is the value effects starting to work for us. We've had good outperformance from low price to book companies. Cyclical companies have really outperformed. Especially we see our exposure in the energy and financial space working for us, and also we have seen a return of liquidity in the market, providing a boost to our small cap exposure. So it's really a combination of lower gearing, lower default activity, but then value effects starting to work for us.
In Europe there has been a lot of new bonds issued. How can that be?
Well, I think there has been a lot of build-up, desire from companies to issue debt in the aftermath of the crisis. You have had a fairly large need for refinancing, and also you've seen, which is more structural, you've seen, I believe, banks trying to move loans away from their own books and into our market, so to speak. Trying to replicate what you have seen in the US for many years, that the corporate bond market is playing a bigger role in the overall financing of businesses. So I think that this wave of issuance in the European high yield market and the European credit market is something you'll see continue for the rest of the year.
Regarding M&A activities, how do you see the risk involved, and how do you protect against them?
Well, for us, M&A is a good thing. We have the cheap bonds from the cheap companies and expect solid returns once our cheap companies are taken over. To protect ourselves against the downside, which could happen if we had a weak buyer of our company, then we operate with what is called a change of control option embedded into our bond. This option gives us the right to sell our bonds at a price of 101 should a change of control event happen. So if we have a bond trading at 80, for instance, and we have this change of control event, our bond can go all the way up to 101 and maybe even higher, giving a very nice return. And if we had a sort of a situation with a bond trading above 101, and that company being taken over by a private equity firm, then we would have a floor protecting us at a price of 101.
You currently have some larger cap investment in your portfolio, although you generally favor the small ones. Is that a consequence of a change in strategy?
No, not at all. Our strategy has been to keep default risk as low as possible. We do that focusing on low net debt to equity, and then we are trying to exploit the opportunities available in the market, working with the value effect and the small cap effect. So right now, on average, we have a higher market cap than the benchmark, but that is due to a few names, a few banks in Europe with very large market capitalization. One of them is Royal Bank of Scotland, and actually we are in the process of taking profit on that exposure. That is 7% of the portfolio where we're taking profit because the company is buying back its own debt. So for us, it's about low default risk, and then if we can get a large cap company which is cheap, we might go for that instead of a small cap company.
What about your predictions for second quarter and the rest of the year? How are they?
Well, I just talked about the large caps and small caps. What we see actually is that we have a huge part of our portfolio which is exactly small cap, and those small caps, they are fairly cheap compared to the rest of the market, and we expect to benefit from that exposure when we look into the rest of 2010 and into 2011. We expect to profit from small cap premiums present in our portfolio. So we still have a focus on small caps, and actually right now we are trying to increase that exposure using you can say the profit from the large cap exposure we had.
So in general, your predictions for 2010 are?
Well, we so far we are up around 11% today, and we expect to see solid double-digit returns when we finish this year.